Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Worley with the New Home Insights podcast. Every year at PCBC, which is the big West Coast housing conference that almost everyone goes to, they have this event called Meet the Money. And it's really popular. You have to pay a little bit more and you enjoy over a little something bacon wrapped and maybe a light Chardonnay, you get to meet some folks who are involved in capital. We're going to have our own little one-on-one Meet the Money with Rodney Montag from Bedrock Land Finance, formerly of Ram Capital. Rodney, how are you doing right now?
I'm great. How are you? What Chardonnay did you have at the last PCBC?
I hate Chardonnay, so I order the best domestic beer they have, usually a Stone IPA. And then as soon as I run out of that, I'm done.
Great.
So I'm finicky. So let's do this. Let's start. We're going to talk again about capital markets, about land markets, maybe if time permits, a little bit about the housing market more generally, but focus on land and capital in the capital world. Let's start, though, with Rodney Montag, and a little bit about your journey to where you are and how you got here to Bedrock.
Sure. If you really want to go way back, I was trained in architecture, went to school for architecture, worked for an architect for a summer or two. The client would come in and tell us everything we did wrong. And I asked my boss, what does that guy do? And he said, that's a real estate developer. So I quickly realized I wanted to be in the development business.
I like that.
I got out of school and I worked for effectively a construction company in New York City that was building a lot of low income and affordable housing. And we turned them into a developer of such. After 10 years there, I joined a home builder in the suburbs of New York and helped grow a business from 35 homes a year to over 400 homes a year. Ended up selling that to a public company, stayed on and helped run that division of a public company in New York. And then really after the GFC, I've been on the capital side of the business ever since then. Most significantly, starting Ram Real Estate Capital about 11 years ago. Ram for 11 years was mainly an equity investor and joint venture partner for land developers and home builders throughout the country. In the past couple of years, we got more into the debt side of the business, which ended up bringing us here to Bedrock Land Finance.
Yeah, and that's an interesting story. And I want to, like I said, on the tease up front, I'm going to go into that with a little bit with some detail. So Bedrock Land Finance is something new for you here, just a few months, I believe, right? That officially, I guess,
I've been official since July 1st, but okay. Bedrock really launched all the way back in March.
Okay, yeah.
So Bedrock is a recently formed subsidiary of TWG Global. TWG happens to be the principal investment arm of Mark Walter. Mark is the CEO and founder of Guggenheim Partners.
Yeah.
Guggenheim's a $300 billion founder investment fund. TWG also owns 4 insurance companies. They have a sports division that I guess most famously owns the LA Lakers, the LA Dodgers, Cadillac F1 team, Chelsea football. But the Lakers is a new thing. He's on the Dodgers for a little while. So TWG got into the real estate business maybe a year ago, doing some multifamily and build to rent on their own. But really this year, and with our help, and we've been speaking about this for a long time with them, launched a lending platform really focused on A&D, land development lending, and land banking. Matt Madison and I from Ram came over to help sort of start up the platform, run the origination side of the business. And real quickly, over the past quarter, we've already closed $150 million worth of A&D and land banking, and We have another 200 million under LOI, which we hope to close in the next 45, 60 days.
So you literally hit the ground running in every sense. You said since we're recording this for listeners in kind of early mid-August. So you've been official since July, kind of quasi-official since March, and you've already done that in your first quarter of existence.
Yeah, for us, it's really just been an extension of RAM Real Estate Capital. So I'm sitting at the same desk. I have the same phone, same office, right? So, and most importantly, same builder partners and developers that we've been speaking to for 11 years, and really in most cases, 20 years.
So the money behind land development, not vertical though, do I understand that right? Or less so?
We are not at this point financing vertical construction. There's a lot of players that are better suited for that, maybe cheaper capital for vertical construction. And most practically, a lot of the banks are still in the vertical construction lending business. And as we speak through, the rest of our agenda here, the banks pulling back from the land development side of the business is a key thesis in why we sort of started up Bedrock.
So you're filling kind of this national gap where you see some of the big players, and you're going to pulling back from the place you're going to kind of focus on.
It wasn't that long ago that there were a half a dozen national home building lenders, banks, that were financing a majority of the A&D for land developers and home builders. Okay. And, almost without exception, they have all pivoted into maybe a different type of financing for builders, but certainly have pulled back on the pure land development side of their business.
Okay. Would you consider yourself a land banker? Is that part of your bag of tricks?
We have two distinct businesses. One is A&D lending, and one is land banking. Yeah. And we view them, for us, in terms of underwriting risk, almost essentially the same. They are obviously very different in structure for either a builder, primarily for a builder. But from our standpoint of analyzing the deal or the real estate or takedown agreement or repayment agreement, it's all land and lots to us.
Do you have sort of at Bedrock, are you thinking strategically, hey, we're going to focus on this, we're going to focus on master plans, or we're going to be really omnivorous and go anywhere for anything? Are you focused on where you'll go and what you'll buy?
Well, we certainly like primary MSAs. Mm-hmm. We happen to like markets where, even if we are not lending to or partners with a large builder or top 10 or 20 builder, we like markets where those builders exist. In most cases, because if a deal were to go sideways, we like to have those builders as another option for us as they take out in the project. But we've already closed projects in Florida and Pennsylvania, South Carolina. We're doing a number of things in North and South Carolina, primarily coastal Carolina, from Savannah to Charleston to Wilmington, Myrtle Beach. We like the East Coast of Florida. We have a project or two there, including something in Atlanta, Southern California, and Phoenix. So pretty wide breadth across the country, but all sort of primary markets.
I didn't hear the word Northern California in there. Is that because of me? You just want to avoid me completely? Is that why?
We looked a lot, and we're looking a lot. It's certainly on the target market list. It just, this is where the chips have fallen for the initial first few quarters.
I can't help feeling like it's a personal shot. Yeah. But that's fine, Rodney. You know what? I'm not angry. So are you, would you prefer, all else equal, being in kind of, big scale? Are you looking for scale? Are you looking more likely to be master plan than it would be sort of a standalone subdivision size deal?
look, scale is certainly, it makes our business easier, right? It's the same amount of effort and work to underwrite a 30 million or $40 million deal that it does a 7 or $10 million deal. So if we're bullish on the market and we're bullish on the real estate, there's no reason that we wouldn't make a bigger bet. And in most cases, a longer bet, right? So um, second part about, there's A&D where we're lending to um, land developers that are selling the national home builders finished lots. We're also lending to home builders that don't have the need for off-balance sheet treatment, who just need A&D debt. And really, our land banking is reserved for, the largest of home builders, and not just the publics, but let's call it maybe the top 50 home builders, maybe top 75 home builders. So one of the nice things about the land banking business, it's a very scalable business, right? So if you do one deal with a large home builder, you're probably going to do 5 or 10 deals with them over the next 3, 6, 12 months. So the repeat business is a great benefit of that business.
Okay. And you mentioned a minute ago, I mean, you don't offer the vertical part of it. So you're just, you're going to help with the land part of it. And so they'll need to go somewhere else for
most of our builders are of size
Yeah.
that they already have a vertical construction line with one of the big national or regional banks. They may have a $100 million or $200 million line, but that line from a bank has constraints on how much land they're allowed to hold within that line.
Okay.
So they like land banking or even A&D debt to move it outside of that facility so that we help them finance that land. And when the lots are finished and they're actually building houses on them, they move it to their construction line. And those banks are very comfortable, A, with finished lots, and B, with the home builder building with a reservation or on spec on those finished lots.
I think you kind of answered my follow-up question. I kind of asked that question as a setup for myself to ask, which is, are banks pulling out or pulling away from that vertical part the way they are the land development part? And is there a gap there as well?
A few banks have for their own reasons, but we don't see that to be a national trend, right? There are plenty of regional and national banks that still love the vertical construction business. And quite frankly, there's a lot of private lenders, similar to Bedrock, similar to thesis, but they like the vertical business. We just happen to like the horizontal.
Okay. So you guys are up and running, you're doing business. So let's talk about the land market. You have your ear is very, very close to what's going on in the world of land. Let's start with just sort of the basic core kind of fundamentals of the land market right now. We know a lot of builders are going kind of land light. Seems like they're, coming back a little more acquisitive very, very recently. But earlier this year, a lot of builders a little bit spooked, a little bit pulled back. They seem to be more judicious in the deals that they're looking at. Two parts of this question. One is, do you agree with that characterization? And two is, how do you see that kind of playing out over the near term?
Yeah. So what we're seeing, in real time is a builder who maybe builds 5,000 homes a year, and they were staffed and they were acquiring land to build 5,500 homes a year and 6,000 homes a year. Now we're only building 4,500, maybe 4,000, right? And maybe that'll stay at that level for a while. They're still going to build 4,000 homes this year. That's not a small feat, and they still need to replace that pipeline of land. So what we're seeing is our builders just buying less land for sure. The deals need to pencil even more so. A lot of builders are going back to their investment committee 2 and 3 times, having gone through due diligence and re-underwriting the deal, everybody wanting to make sure that the deal still pencils. And quite frankly, we've been on projects with a builder where they decided not to go forward because the real estate, something happened and they felt the land was overvalued or, overpriced. And didn't go forward. So we think in a weird way that the deals that we are now seeing are healthier than they've ever been. They've been,
Yeah.
they're the best of the deals that they're
Yeah.
looking at today.
Are you seeing the builders be a little more cautious in the sense of their expectations? Like maybe they're not putting in a price appreciation, home price appreciation, or lesser home price appreciation, or something like that. Are they being more careful in their pro formas? Have you noticed that?
I think price appreciation is so very 2021, right? I, we typically don't put price
Okay,
appreciation
yeah.
in our performers, and I don't think a lot of builders are counting on that today.
Yeah, but they did it. They did it beyond 2021 for sure.
Yeah.
I saw a lot of those. Are you seeing them? Are
Now,
you
let
seeing?
me just let me
Yeah, go ahead.
price. We wouldn't. Keep in mind we're a lender, so we come
Mhm.
at it with a little different view, but we wouldn't invest in a project if we didn't think that over the next 3 or 4 years
Okay.
there was going to be price appreciation.
Okay.
We
Okay.
just don't want to rely on the price appreciation to
Yeah.
get repaid, or we don't want the builder to rely on it to make money on the project.
Yeah.
Right.
It's one more way to build in a little bit of certainty in let's be honest, an environment that's very uncertain right now.
Sure.
Okay. How about in terms of the $1 million question or $1 billion question? I hear that there's a lot. Are you seeing any budging on land prices from landowners, from land sellers? Are you seeing any kind of give back a little bit as the market has been a little more challenged?
Um, we have, but I would not. I think it's a very depending on who the land seller is. It's pretty black and white. Either they're going to sell at a number or they're not going to sell.
Okay, yeah.
And they may say, well, I'm going to wait till prices come up to my price. They may think it's 6 months from now. We may think it's 2 years from now. I guess
Yeah.
time will tell, but we're not seeing a lot of capitulation on the land side.
Okay.
I mean, that's one of the other kind of theses here, that land is scarce. Entitled land is even more scarce.
Yeah.
And if you're a landowner that's able to entitle the land or able to wait out another cycle, I think they would much prefer to wait out the cycle.
Yeah, I mean, just for what it's worth, I'm seeing almost all of that. And you do see some where they want to maintain the supply, like a master plan developer or something like that. But their land is always more patient than the other side of the equation, and should
If
be
the
because, like you
land
said,
seller has some debt that's coming due, that's
yeah,
probably
okay,
the only real,
yeah,
uh, threshold issue that's going to lower prices here.
yeah, or that 50-acre piece where the kids have inherited and they just want to cash in and get out. Maybe those guys, but the major players in land development, they have such a long-term view.
Yeah.
How about, tell me if you know about this one, but development cost, like we're hearing there is a little bit of easing on the labor side, but how about the development side? The folks who are doing the land development, the grading, all that stuff, have you seen any easing back in those costs? Because that can be a big part of that pro forma too.
We've seen definitely easing on the land development costs, certainly on the vertical costs as well. And if nothing else, fewer projects are breaking ground today. There are more site contractors willing and able to bid your project. And there's some good, healthy competition where, a land developer may own, 40 or 50 pieces of equipment, want to keep them busy, and, maybe they'll work for a little less for the year to, keep their team busy. So, we're seeing that. Certainly costs are not coming up. If anything, they're coming down a little bit.
Yeah, and I'm hearing that anecdotally, and I think we're tracking as well a little bit. So on the labor side too, you just don't know how long that's going to last. It's hard to say. With immigration and the potential for labor to be pinched, it could go the other way. So it's another area of uncertainty on the market right now, isn't it?
I mean, immigration, labor, tariffs are all sort of, I don't want to say headwinds, but they're really unknowns. I think everyone's trying to figure it out in real time, and it's the script getting rewritten.
It
So
does. I mean, there's something that's literally unpredictable in the true literal sense of that. Because otherwise, you can kind of tell where those policies are going to go, or at least have a really good idea. You really can't right now.
correct.
Yeah, that's unheard of in, I don't know, the post-war era at least. Where is land hot right now? Cold right now? Any kind of sense of that?
I mentioned the coastal Carolinas.
Hmm.
That's, geographically, that's one market we happen to like a lot.
Okay.
Um, Seems to have some persistent net in migration, if you want to call it retirees or snowbirds or, to be retirees, right? People buying a second home that they're eventually going to retire in.
Yeah.
Florida, it's gotten very, expensive. So I think there's a lot of um, Northeasterners and, Midwesterners that are moving to the Carolinas as a alternate to
Yeah.
Florida.
Yeah.
Um, we happen to like the East Coast of Florida a lot, from Jacksonville down to, West Palm Beach. And there's some oversupply issues in some of those markets. But again, long term, it's the last affordable
Yeah.
parts of Florida. And we're seeing a lot of that. Also, that part of Florida has a lot of, real residents and not snowbirds. And it's people that kind of are there 12 months a year and work for a
Yeah.
living. And so we like that a lot. Atlanta's been very good to us. And then in certain markets, we're seeing different kind of pockets of, if you want to call it green shoots, but there's some markets where the move up market is still very active. It's not used to be a first time home buyer market, and first time home buyers having issues with not only mortgages, but cost to carry of the house. And, but now the buyer of a six, seven, $800,000 townhouse, all of a sudden they don't need a mortgage, and they're probably better, have a better balance sheet. And but those pockets in certain markets we're
Yeah.
seeing as pretty interesting to us.
I'm glad to hear you say that about like the Southeast Florida and places like that, because it's been oversupplied. Listings have gone up and supply has been relatively high, but the demand part of that is still pretty solid. It's just it's that equilibrium is a little bit in favor of the home buyers right now, but the demand is still there in most of those places.
I think the demand is there, and I also think that as all of the I happen to spend a lot of my time in Naples, Florida,
Hmm.
and we so many new homes have been built here
Yeah.
that home builders are buying land in places in parts of Naples that previously were not good home builder markets, right? So when you hear that prices have peaked and prices are coming down, it's really those kind of tertiary
Yeah.
locations in good markets that's where the prices are coming down. If you have you know, uh, a well located project that was well priced in its strong demand area, uh, prices are not going up, but I don't think they're falling like some of the stats that you see.
Yeah, I've only did one thing in Naples. It was like 20 years ago, and it was literally on in the marina or something like that. It was a long time ago, so I never saw the nastier part of Naples. I didn't know there was one.
Yeah.
Okay, interesting. How about those kind of forgotten markets in the middle of the country that are actually doing really well now? Minneapolis, Indianapolis. I'm not sure about Annapolis, but all the Appalases, the Pullises. Are you looking there? Those steady as she goes kind of markets are doing pretty well.
We are, and we actually have some build to rent projects that we are building in um, uh, Indianapolis, Kansas City, right?
Mhm.
Some of those Midwestern markets are just solid. They never
Yeah.
um, had the crazy price appreciation that we saw through COVID, and they're still good, solid markets.
Yeah, they're underrated. They don't have the big ups and they don't have the big downs for the most part either. I've always thought I'm mostly in California now. I've done I don't need to go on a plane anymore to do studies. But the Central Valley of California is kind of like that in the sense that it's the Midwest of California, where it's not as high flying as the coastal areas, but it's much steadier, a little bit safer, and tends to hold its own. Great segue though in terms of sectors. You mentioned BTR. What are you thinking in terms of land for, like, are you looking at multifamily? Are you looking at, it sounds like you are looking at BTR, not just for sale?
We're looking at BTR really just as a building for our own account, right? We're not building and underwriting an exit where we think we have to build for a 7 yield and sell at a 5.5 cap. Um, there's there's parts of TWG that just like the current income of building out a couple thousand units of rental housing, and we could build to a 7 and hold on to it for
Yeah.
5 or 10 years. That feels like the thesis. So um, so we like that. It's harder for us as an A&D lender to finance a rental deal. Most rental guys, either multifamily or build to rent, like to finance those deals with one loan. And yes, we could finance the A&D, and there could be a separate builder coming in and buying those lots that build the horizontal. It's an easier transaction when it's one loan.
That's another good segue to, let's talk about capital and capital trends. And the way you express it there actually is a secondarily good segue because, build to a 7, things like that. I want you to give us a little bit of a primer. And our audience is really diverse. It's not just finance folks. A little bit of primer on capital markets and why are they so challenged right now?
Well, it's funny. I'm a little cynical that I don't know if capital markets are as challenged right now, as there's a lot of real estate asset classes and real estate projects that just don't pencil.
Okay.
Right. So we see a lot of build to rent deals where developers proposing to build to a 6.25 yield on cost and sell it at a 5.5 cap rate. And that spread for us just makes us uncomfortable.
Okay.
On paper, you could probably make money doing something like that, but there are inherent risks of development, not the least of which is construction cost risk, the timing risk, rental risk. And we just feel you need a much healthier margin in order for that deal to pencil. So is that a capital markets problem? I don't think so. I think there's plenty of capital for a good deal that pencils.
Yeah.
When you get into the land side, land has always been a 4-letter word with, the institutional investors. It's harder. It's less liquid. It's harder to sell in a down market. You need to be patient. You need to have time on your side. And I think there's just a lot of capital that for many years you just turned away from land just because there were easier ways to make money.
I mean, land seems like it's the part of this business where you can just make an absolute mountain of money, or you can lose everything.
Yeah, and you have to really know the business, right? Our team is made up of all ex-land developers and home builders, and we know how to entitle, we know how to develop. If we were to take back a project, we could build houses on it if we needed to, right? So we're very comfortable on the land development side of the business.
How about the return on your investment? What is your, just to the extent you can tell us, what is you're looking for, and has that changed over these last year or two?
Well, it's interesting. I think it really hasn't changed for us. It's a low double digits business. We view it that we're a sort of a higher leverage lender. We are going up to 70 and 75%, and in some cases more loan to cost. We, of course, are looking at loan to value and exit value.
Yeah.
So we feel we should be getting paid for that risk. There are certainly, and you talk about scale, a lot of larger land banking companies that in order to get scale, are driving down rates. And that part of the business has become very competitive.
Yeah. I mean, there are, it does seem like there are groups out there who are willing, they're looking for that scale, they're looking for that volume. And it does seem like a very competitive part of the business right now. We do work for probably all of them, but there's a
Yes.
lot of folks out there doing land banking right now. How about at the risk of sounding really dumb, interest rates right now are something like 6.5, maybe a little more than that. I mean, I should say mortgage rates, not the prime rate, but mortgage rates are roughly 6.5 right now, and lending rates are a little lower, but they're still heightened, right? We've had periods, and I don't even mean like the Volcker recession period. I mean, we've had periods where rates are as high as they are now, even higher, and it didn't. Was it this difficult to get deals done then? And if not, what's different now about the equation?
I'm a little contrarian in that I'm not so sure the new build market has a mortgage rate problem. I could walk into any national home builder sales office and I could buy a house with a 4.9%
Yeah.
interest rate. Now, some of that's
If you're walking
artificial.
away from a 3.2, though, that's still a gap, right?
Yeah, sure. But, there's a reason for buying a new house,
Yeah,
right? And
for
maybe
sure.
your family's growing or you're
Yeah,
relocating or you
yeah,
just want a new house. And a lot of people selling used cars to buy used cars, right? There's
yeah,
reasons for it, right? Other than the cost of your mortgage, right?
yeah,
But
yeah,
4.9 feels doable,
yeah,
right? I think in a lot of markets, a lot of buyers are still worried that the prices are too high. And it's not a mortgage. So mortgage rate helps, but I'm still in their mind overpaying for the house. So
yeah,
maybe the answer is we should lower the price of the house and give them a 5.9 mortgage, right? They may feel better about it, right?
yeah.
So I think there's a perception issue with the buyers, and quite frankly, a lot of buyers have been in the market for some time, and
Mhm.
they're looking at that $500,000 house today, and maybe saw it a few years ago when it was 450,
Yeah,
or a few years ago when it was 400, and they're feeling like they're overpaying today.
yeah.
Although there's many reasons why that house is it's worth more today. Um,
There is, but yeah, no, it's certainly every measure of affordability is worse now than it was pre-COVID, mostly by a lot in most
yeah,
markets. And it does seem like prices are softening now. We've seen that in lots of markets. Do you think that given that prices are softening in some markets, even going negative now year over year, that the land part of it is maybe a little disengaged or disconnected from the home price part of it? The land
land
price,
is
I should say.
definitely disconnected from the home price,
Okay.
right? We are seeing, and not just recently, but over the past year and 2 and 5, right? I'm old enough to remember the lot to home price ratio
Yeah.
used to be 20%, even
Yeah.
18%. And then it went to 22 and 27. And now in most markets, we're seeing, 30, 35% lot to home price ratio. In California,
Oh,
it's
much higher.
50 or more, right?
Yeah.
So,
Yeah. The coastal areas of
um,
California will be 45, 50, or yeah.
now all other costs being the same, the houses of the price, the price of the homes are that much higher. So, and look, the home builders, despite the last quarter or two, the national home builders are still making a relatively healthy margin, right? Which leads you to believe that there's room to pay market for land, as long as they could sell houses for market rate. And
Yeah.
we may have a bump in the road here for the next couple of quarters, but seems like the builders are very well in very good shape to weather a storm.
They definitely are for the most part. I think the concern is that they're again is going back to that uncertainty factor. They're not sure if some other shoe is going to drop or something else might happen. Like the economy, we've seen that job growth has slowed. It's still positive, but slowed these last few months or so. That might be concerning. The future might be a little bit concerning in an industry that is mostly glass half full, especially on the development side, for sure.
Correct. We agree with all of that.
Beyond the Fed lowering rates, what do we need to see for these land deals to be more likely to pencil? What are the other inputs we should be looking for or hoping for?
Um, it's a great question. I, Again, I think there's a lot of land deals that we see that do pencil. I think just every builder is trying to right size their land purchases,
Okay.
right? And if a home builder is typically had 6 or 7 years or 5 or 6 years of land on their books or land under control, right? And now they're building fewer homes this year. All of a sudden, they have 7 or 8 years of land on under control. So they're just buying less land.
Yeah. Okay.
And I think we're just seeing fewer transactions. I know we're just seeing fewer transactions today and not worse transactions. I mean, the other thing in addition to price is absorption, right? So
Yeah.
a builder may have been looking at a deal that, um, a year ago they might have penciled 6 or 8 sales a month, and now they're penciling, 4 or 5 a month. And we have the benefit of underwriting it today at today's absorption at 4 or 5 a month. And if the deal still works on those numbers, we're okay with it. We give it a green light.
Yeah. I mean, not to be glass half empty, but I think the days of 4 or 5 a month routine absorption are mostly in the rear view unless you're kind of below market because absent COVID, that was not the norm. Maybe 4 months is considered a norm in those more affordable markets. But we're not expecting mortgage rates to come down below 6+% anytime soon. I know the buyers can buy it down, but they've been doing that for a long time. So I wonder if at some point builders and developers are going to have to reassess what they think the long-term norm is in terms of absorption.
Well, on the flip side, right, I feel that, again, when I'm quoting those numbers, those are sort of
Yeah.
larger projects, larger master plans that may have, 2, 3, 4 different product lines and
Yep.
different, types of homes in them.
Okay.
But on the other hand, you know, having been a home builder and having, um, run the P&L of a home building business, you you need a community to sell 4 or 5 a month in order for it to cover the overhead, right? So, we it there may be plenty of projects that on paper seem fine to sell 1 or 2 a month.
Mm-hmm.
We wouldn't fund one of those projects. We just don't think that it contributes enough cash to the bottom line to make it worthwhile for a builder to maintain that long term.
And of course, there are always those really hot times where it's 4 or 5 sales a month, but that's only because you sell out in that first weekend of release and you have to have the next release. We like those. How about in terms of your terms? Are you trying to de-risk things? Are you looking at shorter timelines for a certain project to build out in or anything like that?
Well, the immediate answer is no. However, shorter term deals, projects with bigger either deposits from a land
Okay.
banking partner or a more equity from a builder. Those are all things that get preferential treatment, right?
Okay.
That we certainly like them more, but we have plenty of projects that we're working on that are 5-year deals that we're comfortable with. We've done
Okay.
land banking deals as low as 10% deposit. We're comfortable, in certain cases with that. So I think there's always a exceptions to the rule, but we don't mind duration. We actually have a few structures that we like that maybe some of our competitors don't do. We are land banking future phases of larger projects or larger home builders where maybe it's 1,000 lot project and said home builder will buy the first 100 or 200 lots and develop them themselves, and we'll hold the next 800 lots and they'll buy phase 2, 3, 4 from us when they're ready to develop those. We'll never develop those phases, don't have a deposit on those to buy them for us, but they're doing the offsites, they're improving
Okay.
phase one, they're bringing utilities to us.
Okay.
They're somewhat improving our real estate, but it's just a future phase hold program. And a lot of the larger builders like that
Yeah.
for some of the larger projects that they are being.
Anything that brings land flexibility, because we don't know what's going to happen in the next several years, I think it has to be a positive, whether it's plus
Yes.
or minus, because they can speed that up, right? In that same scenario you just played out, they can certainly speed that up if the market takes off.
Correct.
Okay. I want to ask you, I want to switch over to, for a couple minutes anyway, to the housing market. I know, hey, we're at John Burns. We're the housing market experts, but I'd love to hear all kinds of voices. And you obviously are looking at the housing market very closely. So just a couple of questions. I know you're not in the multifamily space, but maybe let's talk a little bit about for sale and then BTR. Just your sense. What do you think about how the for sale part of the housing market maybe plays out over the next year or so?
Well, let me answer in reverse, right? I think
Okay.
over the past couple of years, right, multifamily and build to rent were tough to pencil. And whether it was a capital markets problem or not,
Mm-hmm.
right, fewer rentals got built.
Yeah.
And, more standing inventory or pipeline got absorbed. And fast forward to today where whether we have a strong for sale market moving forward or not, a number of people have just been priced out of buying a home.
Yeah.
And where I think, over the last 5 years, maybe there were a lot of tenants by choice that they wanted a rental. They don't want to put up a deposit. They were maybe more transient nature. They wanted to pick up and move when they wanted to, and they could work from anywhere, not just from home. So I think there were a lot of great reasons to rent a home or rent an apartment. Today, I think a lot of people are just being forced to,
Yeah.
right? So, or they're afraid to buy, so they're renting. And I think, that has certainly helped the pipeline of units that are of rentals that have been in the market. And I
Mhm.
think, over the next couple of years, I think the multifamily business is, both apartments and single family rentals
Yeah.
are a great place to be, just because people are priced out of single family.
Yeah, and it's a combination, isn't it, too? It is the folks who are priced out for sure, and that's been propelled these last few years dramatically. But it is I think that's an underestimated, not by the folks in the business, but from folks elsewhere in the real estate space, is that how many tenants, especially in BTR, are tenants by choice. It's just like there's no maintenance. You can walk away and go. You're testing a neighborhood. There's so many reasons, especially in the BTR world, where the product isn't apartment-like product to be a renter rather than a buyer.
Yeah, and now I think we're seeing people that are, I'm not saying being forced into it, but can't buy a new home
For
today,
sure.
so they're continuing to rent.
Yeah, and their family or whatever. So apartments aren't very appealing to them because of product.
Sure.
So single families. Okay, so now the for sale part. Then, what do you see the for sale market?
Look, we have a long-term view of the world. We still believe there's a housing shortage, right? There's certainly a land and lot shortage. And we think, we're in the middle now of a reset, and clearly mortgage rates are going to have something to do with that. Um, I don't think we're smart enough to know whether it's going to be another 6 months or another year or two, but um, look, we're still in a reasonably healthy housing market, right? Home builders can still build and sell homes and make money at it. There's still buyers buying homes, right? The prices may not be what the builders want. The absorption may not be there. I just think we're going to have a slower absorption, flatter market, probably for the next year or so.
Yeah, and we're in the industry, a sector where when they want to kill inflation, they kill housing. But when they want to gin up the economy, you gin up the housing part of it as the the kind of leader in trying to restoring the economy. So if the Fed does see the economy maybe slowing, then it makes sense for them to lower interest rates. We'll see.
Well, I also think if they see the housing market slowing too,
that's true.
right? And
yeah. So what's next? I know you've only been around existence for a couple of months or so, but what's next for Bedrock? Have you got any other thoughts on where you're going to put your money?
well, look, we're certainly busy. There's no shortage of builders that need capital. Um, we we think we have a competitive advantage. There's some excellent, competitors out there, and I'm friends with most of them. But from our standpoint, we are using our own money. We don't have kind of third party investors. It's all house money. That gives us the ability to have flexible offerings, right? We don't really have a one size fits all approach to any of this, right? We truly do underwrite each and every deal with each and every builder, on its own. Our capital is scalable. We're probably on track to do $1 billion this year. We certainly hope our plans are to do multiples of that over the next year, 2 or 3. And I think our experience, in the land development and home building world, is appreciated by our borrowers, right? We're not just a lender. We're not a bank. We come and see every site, and we talk real estate and talk home building and land development. And I think our good borrowers really appreciate that and understand that.
Would you ever go outside the capital there in the lending part and do some do your own community, like maybe BTR or something like that? Would you think about that?
We are doing some of our own BTR. We are also impiling a deal or two on our own. I would say they're more of exceptions than the rule. But when we see we like single family rentals, right? I'd rather buy a piece of property, entitle it, and build it, and have it at a 7% yield on cost than go buy a completed community at a 5.5 yield on cost. And we'd rather do all that work and do all that effort and get a higher return. We have the expertise and the ability to do that.
And it's nice, like the opposite of when you're a young architect. Now you could tell other people why they're wrong. So that's fun.
Well, it's funny, like we are on site with some of our builders, and we're walking a model, and we're commenting on sill heights and window locations, and the builder expected us to be just the money in the deal, and we actually have an opinion. And
I like that. You surprise them. That's good. That's good. Make them think. All right. Rodney, thank you so much for coming on the show. We'd love to meet the money, and you're the money.
Dean, thanks for having us. I enjoy your podcast and glad to take part of it.
Thank you. This is Dean Worley for the New Home Insights podcast. We'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.